How to identify undervalued or resilient stocks in the Australian market. One of the challenges of investing in a dull market is finding stocks that can offer good returns and withstand market volatility. In this section, we will discuss some strategies and tips on how to identify undervalued or resilient stocks in the Australian market. Undervalued stocks are those that trade below their intrinsic value, which is the estimated worth of a company based on its future earnings and cash flows. Resilient stocks are those that can maintain or grow their earnings and dividends even during economic downturns or crises. There are different ways to find undervalued or resilient stocks, but here are some common methods. Use valuation ratios. Valuation ratios are metrics that compare a company's share price to its earnings, sales, book value, cash flow, or dividends. Some examples of valuation ratios are price to earnings, P/E, price to sales, P/S, price to book, P/B, price to cash flow, P/CF, and dividend yield. These ratios can help you assess whether a stock is cheap or expensive relative to its fundamentals. Generally, lower ratios indicate undervalued stocks, while higher ratios indicate overvalued stocks. However, you should also consider other factors such as the industry average, the growth prospects, and the quality of the company before making a decision. Use discounted cash flow analysis. Discounted cash flow analysis is a method that estimates the present value of a company's future cash flows. This method requires you to project the company's future revenues, expenses, capital expenditures, and free cash flows, and then discount them back to today using an appropriate discount rate. The discount rate reflects the risk and opportunity cost of investing in the company. The result is the intrinsic value of the company, which you can compare to its current share price. If the intrinsic value is higher than the share price, the stock is undervalued. If it is lower, the stock is overvalued. Use quality indicators. Quality indicators are measures that reflect the financial strength, profitability, and competitive advantage of a company. Some examples of quality indicators are return on equity, ROE, return on invested capital, ROIC, operating margin, debt-to-equity ratio, interest coverage ratio, and earnings stability. These indicators can help you evaluate whether a company has a sustainable business model, a strong balance sheet, and a loyal customer base. Generally, higher quality indicators imply more resilient stocks, while lower quality indicators imply more vulnerable stocks. To illustrate these methods, let's look at some examples of undervalued or resilient stocks in the Australian market. CSL Limited, ASX. CSL is a biotechnology company that develops and manufactures plasma-derived and recombinant therapies for various diseases and conditions. CSL has a P/E ratio of 38.8, which is lower than its 5-year average of 42.9 and its industry average of 48. CSL also has a ROE of 25%, which is higher than its 5-year average of 23% and its industry average of 15%. These ratios suggest that CSL is undervalued relative to its peers and has a high-quality business with strong profitability. Woolworths Group Limited, ASX. WOW is a retail company that operates supermarkets, liquor stores, discount department stores, and online platforms in Australia and New Zealand. Woolworths has a P/CF ratio of 16.9, which is lower than its 5-year average of 18.4, and its industry average of Woolworths also has a dividend yield of 2.3%, which is higher than its 5-year average of 2% and its industry average of 1.8%. These ratios suggest that Woolworths is undervalued relative to its peers and has a resilient business with stable cash flows and dividends. Macquarie Group Limited, ASX. MQG is a financial services company that provides banking, advisory, investment, and funds management services worldwide. Macquarie has a P/B ratio of 2.6, which is lower than its 5-year average of 2.9, and its industry average of Macquarie also has an interest coverage ratio of 6.7, which is higher than its 5-year average of 5.8, and its industry average of these ratios suggest that Macquarie is undervalued relative to its peers and has a strong balance sheet with low debt risk. Of course, these are just some examples and not recommendations. You should always do your own research and analysis before investing in any stock. To sum up, identifying undervalued or resilient stocks in the Australian market requires you to use various methods and tools to evaluate a company's share price, fundamentals, and quality. By doing so, you can potentially find stocks that can offer good returns and withstand market volatility in a dull market. One of the key strategies to invest in Australian shares in a dull market is to diversify your portfolio. Diversification means spreading your money across different types of investments, such as stocks, bonds, property, and cash. This way, you can reduce the risk of losing money if one or more of your investments perform poorly. Diversification can also help you increase your returns by exposing you to different sources of income and growth potential. For example, some investments may pay regular dividends or interest, while others may appreciate in value over time. By combining different investments, you can balance out the volatility and performance of your portfolio. But how do you diversify your portfolio effectively? Here are some tips to consider. Choose investments that suit your goals, time horizon, and risk tolerance. Depending on your personal situation and preferences, you may want to invest more or less in certain asset classes or sectors. For example, if you are looking for long-term growth and can tolerate higher risk, you may want to invest more in stocks than bonds. If you are looking for income and stability, you may want to invest more in bonds than stocks. Don't put all your eggs in one basket. Even within an asset class or sector, you should diversify across different companies, industries, and regions. For example, if you invest in Australian stocks, you should not only focus on the top 200 companies listed on the ASX, but also consider smaller or emerging companies that may have higher growth potential. You should also look for opportunities to invest in global stocks that can give you exposure to different markets and economies. Use index funds or exchange-traded funds, ETFs, to diversify easily and cost-effectively. Index funds and ETFs are types of collective investments that track the performance of a specific market index, such as the S&P/ASX 200 index. By investing in an index fund or ETF, you can gain access to a diversified portfolio of stocks with just one purchase. Index funds and ETFs also have lower fees and expenses than actively managed funds, which can boost your returns over time. Review and rebalance your portfolio regularly. Diversification is not a set-and-forget strategy. You should monitor your portfolio periodically and make adjustments as needed. For example, if one of your investments has performed exceptionally well or poorly, it may change the overall risk and return profile of your portfolio. You may need to rebalance your portfolio by selling some of the overperforming investments and buying more of the underperforming ones. This way, you can maintain your desired level of diversification and avoid being overexposed or underexposed to any particular investment. Diversifying your portfolio is a smart way to invest in Australian shares in a dull market. By following these tips, you can reduce your risk and increase your returns over time.